welcome to Next Gen Finance, an SEB podcast about sustainable finance. My name is Lina Apsheva. I'm an analyst in climate and sustainable finance here at SEB, and I'm going to be your host for the next half hour or so. So if you've been following our podcast, you know that in the past couple episodes, we've been focusing on the topic of greenhouse gas emissions. And greenhouse gas emissions have always been and still are one of the central topics when it comes to sustainable finance, even though now it's becoming a lot more than that, and the market is really expanding to include other things. But today we're going to sway a little bit away from that conversation, even though we'll still talk about emissions to some extent. But what we will focus on is what happens when the market starts turning away from greenhouse-heavy activities and towards things like renewable energy. We will learn about the energy transition and SEB's research in sustainable finance, and also get expert opinions about what we can expect in 2023 when it comes to these things. And I can't think of any better people to talk to about this than my guests today, who are Thomas Thygesen, the head of strategy for equity research, and Elizabeth Mathiesen, who is a senior strategist within equity research at SEB. In addition to that, you are also the co-editors of SEB's flagship research in sustainable finance, the Green Bond. Thank you so much for joining me in the studio today, and welcome.
Thank you, Lina.
Yeah, thank you. It's a pleasure to be here.
So I think a lot of people listening to us will probably have questions about what you actually do, because it sounds really interesting. It's equity strategy and research. So I was wondering if maybe you could explain a little bit what your roles are in the bank and what your team works with.
Well, the strategy team in equity research, our job is to figure out which parts of the stock market that are likely to do better on both short and long time horizons. And the traditional way of doing that is to focus on the macroeconomic cycle. Will there be a recession? What's going to happen to GDP growth and earnings? But there are also some deeper topics, and those are actually the ones that are most important for stock pickers in the equity universe. Not just what happens this year, but what are the deeper trends, what happens the next 10 or 20 years. And that's why we felt it was such an obvious idea to try and operate in the nexus between sustainable finance and equity strategy, because we think we're approaching the point where these two things will merge and where sustainable finance becomes a vital part, or not least transition analysis becomes a very vital part of the stock selection themes for the future.
And maybe I could just add that this was actually one of the first topics that I got to work with when I started here at SEB. That was looking at these structural movements and big sort of waves that you see over several generations. And I know that, especially here in Sweden, that you're very good at having these and developing these sorts of companies over a longer period of time as well. So it was, like Thomas said, a no-brainer to try and combine both the equity side of things and also the sustainable and transition aspect of that as well.
That sounds great and so interesting. And you've mentioned the word transition, right? And I think it's important to explain, what do we actually mean when we say transition? And that's also one part of the research publication that we work on, right? The transition update. So could you just give us an overview of this word in the context of sustainable finance?
Well, if you want to explain the word, it might be a good idea to look at history, because what we're dealing with right now is a shift from one major driving technology that's been propelling most of our economy for 250 years to something completely different. So a transition would also be the shift when computer technology started replacing more manual ways of making calculations. Or if you go earlier, when the automobile replaced the horse carriage, or when the steamship replaced the sailing ship, each of these events took around 90 years to complete. It's several generations. It's a massive job. And when you're done, you will have a completely different economy with very different characteristics, and hopefully also with a cleaner environment and a better standard of living, because that's the beauty of all this. This transition we're talking about is essentially a technology revolution, and we've seen some of those before, and we're trying to apply the lessons from earlier similar transitions to the current one.
And what would you say is the current transition? How would you define that?
Well, I think that relates very much to sort of the energy side of things. That's kind of been the missing aspect if you look at it in relation to the IT revolution. we were missing the energy component of that to accompany and finalize that revolution. We have to try and look across the whole spectrum of sectors that we have in the economy, because that is the key for this transition that we're in right now, the energy transition, to try and electrify across all sectors. And it's perhaps easy in some, but a challenge in other sectors. And that's also what we focus on in our research in the Green Bond.
There has always been an energy component in all the technology revolutions. So if you go to the 1800s, it was coal that was replacing, well, whatever we had wood burning before, and the steam engine required the coal. And if you look to the 20th century, we were all looking to the combustion engine, the automobile, and that was the century of oil. And for reasons you could call historical accidents, we had been spending decades trying to develop a clean alternative to fossil fuels in nuclear energy. But we dropped that ball, you can say, for good or bad reasons. People have different opinions of it. But essentially it meant that we are still well into the 21st century using the energy technology of the 1800s and 1900s. That's why we have a climate crisis, and that's what we need to figure out, how we can accelerate the transition, since we kind of started a bit late with it.
I mean, no one listening to this is going to doubt how important this concept is when it comes to actually addressing the problems that we're facing now with climate change and other environment-related and social even factors. So I'm thinking in the past 20 years or so, when it comes to innovation, when it comes to technological landscape, it's changed so much. Even just if you think about the cell phones that we each have in our pocket, that was not something that was available to everyone. So I am wondering if you could tell us a little bit about how the investment landscape shifted as all of these new technologies were entering the market and as our society has been changing over the past 2 decades, especially in relation to things like renewable energy. So, to sway the conversation a little bit back to sustainability.
Well, if we start with the IT revolution that you're referring to, I think everybody can see that it is a complex thing where waves of new companies enter that maybe did not exist before or have transformed themselves to ride this new growth wave. And that's, of course, obvious to everybody who looks at computers. Every 10 years, you look back and the computer you had 10 years ago would be completely useless. 10 years later, you get an iPhone. You wouldn't want to look at your computer from 10 years ago. Now, the funny thing here, Elizabeth, is that this is exactly what's going on with renewable energy as well.
Yes, and if we look at the amount of investments we've seen over the past 10, 15 years, well, the way that we phrase it is that we see it as a lost decade, because even though there's been a lot of focus on investments in renewable space, well, then in investment terms, if you look at it in dollar terms, then not a lot has actually happened there. But it's starting to shift now as you get a lot more focus on ramping this space as well.
But I think the real important point is that to understand that this new technology, say for many years when we were discussing this, until a few years ago, we were talking about the energy transition as if it was something we had to do primarily for the sake of the climate. And it is something we need to do for the sake of the climate. But what people often don't realize is that under the surface, the renewable energy technologies are evolving pretty much like microprocessors did, aren't they, Elizabeth?
Yeah, so we see this sort of when you enter into this 30-year period of price declines and exponential volume growth. Well, this is in effect the same thing as Moore's law. So when things start to decline in price rapidly, they also start to become more efficient, and you have this learning by doing process. So as we stand here today, in fact, renewables are cheaper, and they weren't the cheaper option technology-wise just a couple of years ago.
Being a man of a certain age, I can tell you that the computers we had in the 1970s when I was a boy, they were completely useless. It was hard to imagine at the time that this would transform the world as it turned out to do. And if you're looking at renewable energy 20 years ago, it was the same thing. It was expensive. It wasn't the best option. And maybe that's why we weren't forward-looking enough to understand that we're missing not just a climate opportunity, but also an economic opportunity by sticking with old-fashioned technologies that should have been phased out decades ago. And that's what's changed in the past couple of years. Everybody seems to understand now that this is something you also do to get a better economy and a cleaner economy. But a better economy also means you can lift billions of people to higher standards of living over a generation or two in the poorest parts of the world if we can develop this technology fast enough.
I'm glad that you mentioned the poorest parts of the world, Thomas, because that was actually where my mind was going a little bit and where I wanted to ask the next question. So someone might say, this is very true when it comes to Denmark or Sweden or other parts of Europe or the United States. But what about parts of the world where that infrastructure is not available? Is it the same situation that you see there? And what does the investment kind of paradigm look like in those parts?
Emerging markets or developing economies, that's one of those areas where I think investors can make a difference. There are many reasons why markets are a little bit reluctant to go to these countries. They offer, say, political and other risks that you don't find in a place like Sweden or Denmark. But the good news is that the lack of an infrastructure, many of these countries did not actually build a complete fossil-based infrastructure. They were simply too poor to do so. Well, that also means that you don't have the legacy, the obsolete assets, and the internal resistance towards change that you do if you have a powerful fossil fuel industry that is resisting change. So there is an example here. If you look at telephones, for instance, the mobile phone transmitted very rapidly through Africa. They did not have fixed line phones before. They just jumped to a new generation of technology faster. But the problem is, of course, how do you finance this? Because there's not that much money in these countries. And I think this is where investors in our part of the world actually could make a difference if they can find a way to live with the risk of being in strange and maybe more dangerous parts of the world with their money.
Definitely. And we already see some form of instruments that are coming up that are focusing exactly on this type of financing, isn't it? So, I think it's going to be an exciting decade in front of us, and we'll see where that takes us. But at the same time, there are all these different shocks, geopolitical shocks, the pandemic that are coming and making a dent, I guess, in the market and the investment flows. So how do you think the pandemic specifically and also the war in Ukraine, the most recent shocks, affected this flow of investment?
I think that's a very interesting question. So obviously you're right that these were tragic events that disrupted what was happening otherwise. But I guess, Elizabeth, you could also see this as a catalyst, right? So we have actually seen things change direction as a result of these disruptions.
Yes, that's correct. So the catalyst that we saw not only from the pandemic, which caused huge societal changes, and then later on that was amplified by the energy crisis that came as a result of what happened in the war in Ukraine. And that has actually changed the way we completely view the trajectory going forward for investments in renewable energy space. So it's no longer just about the climate. It's also about becoming independent, energy independence as well from a European perspective. And that is really what is accelerating investments into this area. And we can already see that we haven't got full year numbers for 2022 yet when we look at clean energy investments, but we hope to see exponential movements also in the next decade going forward.
And I guess if you look at the European situation, I mean, what Elizabeth is talking about is quite clear here. Our energy policy is not economic policy anymore, and it's not even climate policy. It is security policy after you realize the hidden costs of just taking the cheapest option in the shape of Russian gas. The price came up later that you are dependent on somebody who might not share your worldview or the ideas about how society should evolve in the future. And now I don't think there is a budget limit anymore. I think we will pay whatever it takes to radically change our energy structure as fast as possible. Well, interestingly enough, we now have this discussion going on between Europe and the United States because the Americans have finally woken up as well with the Inflation Reduction Act. And now we have to catch up with them. But at the same time, China is moving very fast. They started a year or two before us. They had an energy crisis before it even happened in Europe. And they have been massively ramping up their investment in the energy transition as well. So sadly, these tragic events, of course, are not what we had hoped would be the trigger for breaking the gridlock and finally starting to see an increase in investment. But we'll take whatever we can get. And if this is the driver that was needed to finally change the trajectory and give us a chance to decarbonize before we ruin the planet, well, we'll take that one as well, even if it wasn't the one we hoped for.
And Elizabeth, you mentioned numbers a little bit. So I'm wondering if you could give us a little bit of, look into what do these volumes actually look like. So when we're talking about transition and investment in the transition, what kind of numbers are we talking about?
Well, if we look at the clean energy space and those investment numbers, well, then our forecast is that by the end of this year, we'll reach close to $600 billion in investments on aggregate. And if you look at that from a geographical perspective, well, then that's Europe and China driving that, as Thomas alluded to before. And we have the US sort of playing catch up here. So if we talk about 600 billion by the end of this year, well, then it's difficult to wrap your mind around this. But then by 2030, we could have seen a doubling of that number and yet another doubling of that number. And that's sort of the exponential move in the curve that is difficult to quite grasp. But the trajectory for this year, we are very optimistic about looking at clean energy investments.
Yeah, these are numbers that are so big you can hardly fathom them, right? Doubling and then doubling again. I mean, this is not something that is very easy for most people to look at linear extrapolations. We think like things move in the way that they have done in the past, but things that just keep accelerating. I mean, it is exactly very close to when you are looking at how fast the internet would evolve. The early ideas were completely wrong when you look back at it 20 years later. So we're thinking 20 years from now, we're going to look back at this and say, how could we imagine that we'd be done with 600 billion a year? It is obvious we need more. And the economic motivation for getting that investment on the ground and the geopolitical motivation, not least, is now in place.
I think this is great because when you look at these shocks and really horrible events that have happened, you can still find the silver lining because in a way that these events and these shocks push the transition forward and move us more in the direction of a sustainable future. And something you mentioned quite a bit in this conversation is clean energy investments. And could you provide a few examples of what exactly does that mean? Is it solar panels or what do we mean when we say this new technology?
Well, that's also a very interesting distinction to make, right? What we're talking about here is only the investment that results in electricity coming out from new sources. So it could be a windmill, it could be a solar panel farm, and also the grids, the stuff that connects these things and allows the electricity to come out to where you use it. But the interesting thing and the challenging thing is that that's not nearly enough to get there. There are plenty of other sectors apart from energy that now need to rethink what they're doing. So imagine you have a fleet of ships that today run on a diesel engine. You got to start thinking about 20 years from now, all of those ships need to run on a different technology, and we're not really sure yet what that technology is going to be about. So, of course, it's wonderful news that governments are now driving the change in renewable energy. There will be abundant clean electricity. But what about those sectors that can't use electricity, that are like locked into fossil fuels because their engines or their technology for turning iron into steel simply can't work without that kind of energy? That's the second challenge. And this is where we think there's a lot of private sector interest, because that's not going to be handled by our governments. That's up to the companies themselves to figure out when and how do you make the jump. How do you allocate your capital over the next 20 or 30 years? It's not easy. It's a very complicated thing for the companies. But at the same time, it is a fantastic opportunity. Just like the first companies that found out how to use computer technology, they got a head start on their competitors. The first companies that crack this code and find out how you use renewable energy to power a ship or a steelwork or a cement factory with no CO2 emissions will not just be the cleanest ones, they will also be the successful ones. But if you look back at the computer revolution, you would also see companies failing, picking the wrong technology, making the investments at the wrong time. So you have to be careful. It is a very complicated situation, and that's exactly why this translates into also equity strategy, not just sustainable finance and climate research.
Yeah, thank you for explaining that. I think it's a very important distinction there. And these are the things that we very often, on a regular basis, discuss in the Green Bond Report. So let's talk a little bit about this report and this work that we do now. When we're recording this podcast, the next issue is about to come out. And I was wondering if you could tell us a little bit about what is the report about, and specifically the upcoming issue. What is it going to focus on?
The report itself, of course, is there are certain elements in the Green Bond that are in every issue. Every time we publish an issue, we will update our readers on progress in the transition to a new energy system, and also on developments, of course, in the market for sustainable finance. These two things are closely linked. Hopefully, they will continue to be closely linked in the future as well. But then we pick out specific topics. And the one we're going to write about and have external contributors write about in the coming issue is something that's very interesting and relates exactly to what we talked about before. Complications with the transition also include the enormous amount of commodities and other physical resources that go into it. That's one of those things I think over the past few years has become increasingly clear that if you want to build 100 million electric vehicles with batteries like we know them today, well, you're going to need a bit more commodities than we currently can produce to do that. So we're focusing on some of those challenges that need to be overcome. And in this issue, the challenge is that we're going to need a lot more commodities. And that's tricky because commodities is one of those sectors that today have high emissions, but that also are playing an indispensable role in the transition itself. So I guess the challenge here is to figure out how do we keep those commodities coming for the transition at the same time as we also see the mining industry shifting to a completely new and much cleaner technology. It's not easy, but it has to be done, and that's the topic of the next issue.
And I think that there will also be a focus on the opportunities in connection with that as well, related to circular economy and also to how we can have greater economic efficiency as well, just to add on to what Thomas said there.
I think, Lina, that's also, like you alluded to earlier, sustainability is broadening. It's not just about the emissions anymore. And circular economics is not just something to do with saving a bit of energy. It's also a way of reducing the broader resource impact we put on the planet beyond energy. Well, how we deal with the issues like mining, for instance. How do we make sure that we don't ravage the earth in our attempt to make a better earth for ourselves? So recycling is one of those things, but there are many other ways where you could see opportunities for companies that can help us do the same thing, but use fewer resources. That's another way you can get a head start when it comes to averting a climate disaster.
I'm sure that a lot of our listeners will be very interested in reading this upcoming issue, but also the Green Bond in general. And this issue we've talked about is coming out on the 2nd of February. You can find the report on the SEB Group website, which is sebgroup.com, or simply by Googling SEB Green Bond Report. And the full title of the report is Your Insight into Sustainable Finance, which it truly is. So we're kind of coming to the end of this episode, and there is a question that I often ask my guests, which is if you could give a piece of advice to someone listening to this episode who wants to integrate sustainability into their way of working, whatever it may be, what would that advice be?
Understand the complexity of the issue. I think that's a very important message. As we just alluded to here in our discussions, it's not just like a linear street that is predictable in advance. It does involve a lot of internal contradictions, like we're talking about. How do you square the need for commodities with the fact that commodities are, well, a high emission sector where the emissions are hard to abate? How do you combine the biodiversity aspect with the need to do something that has more of an energy transition in it? It's important that we understand that this is not easy, because if we understand that it's not easy, then we can start working with the complexity and getting things done. So I think that's the main advice, that you have to understand that transition. If you looked at computers in the 1980s, the companies we thought would be the world winners in that revolution, most of them are not there anymore. So be prepared for changes, be prepared for things happening that you hadn't predicted, and understand that this is a complex situation that will not give you an easy fix. Then we can start doing the actual job of getting the transition over in time to avoid the climate disaster.
And I also think, just to add to that, just to be open-minded, that things develop very quickly all of a sudden, and try and incorporate that into your line of thinking, whatever you may work with, whether it's economics or within the financial industry or from a company perspective, and try and also be curious to follow some of these trends, and hopefully also try and also be part of this shift going forward.
But the one thing I would say is that the future does look bright. We are very, very optimistic. Keep the focus on that. We're moving in the right direction. We have the technologies we need. If we put all our efforts into it, we can get there in time. So it is a very, very positive story. This is the first time since I started looking at this. I truly believe that we can do it in time, complete the decarbonization of our economy by 2050. But it will require that everyone makes an effort. Just mindful also, if you're in a company, this is not just a threat, it is also an opportunity to make your company better and more competitive. And when you focus on that, it becomes so much easier also to justify all the investments that will be needed, even if the ultimate motive and the most important thing, of course, is to make sure that the planet stays inhabitable.
Thank you so much. That is great advice, and I can only agree. And Thomas, Elizabeth, thank you so much for making time in your very busy schedules and coming to talk to us today.
Thank you, Lina. It was such a pleasure to be here, and we'd love to come back one day.
Yes, thank you.
Thank you so much to our listeners for tuning in. As always, you can reach out to us at nextgenfin@seb.se with any questions or suggestions for topics that you'd like to hear about. But for now, thank you and goodbye.